Alright, so let's start with the basics. I want you to understand how trading works. So, what you're doing basically is you are buying and selling instruments and assets or commodities like gold, silver, Bitcoin, a currency pair, or a stock exchange, or something like that. You're buying a financial asset or selling a financial asset, that is trading. But you alone as an individual cannot do trading. That's why you have to go through a broker who is going to help you make a trade. So if you have absolutely no idea about trading, this is how it happens. So the very first step for you to start trading is for you to have an account with a broker depending on whatever markets you're trading. So if you're trading Indian markets, Indian stock market or US stock market, you need to have a demat account in India, or you need to have an account with Robinhood or international broker, iBroker, whatever the platform is. Or let's say if you're trading Forex, you need to have a account with IC markets or any broker that you know in your locality. Or if let's say you are trading gold, once again you need to find the right broker for that. So whatever market you're trading doesn't matter, but the first step for you to start trading successfully is to find a broker, a good broker, which is going to help you trade. So basically these brokers are the people who are going to help you through their platform to place these trades. Now when you place these trades, there are certain ways to place these trades. There are certain ways and different types of orders to place these trades. Before we get into the orders, I want to tell you one very simple thing. In the markets, there is a way how you can make money by the price going down. Now, when I heard this for the first time, it did not make sense to me at all. So this concept is called short selling. Okay. Now let me explain how you can make money if the prices go down. So let's say today the value of an iPhone 15 is around $1,000, right? Now you tell me, is the value of that iPhone going to decrease by next year or increase? Very obvious, it is going to decrease. So let's assume, now this is a very unrealistic example, but I want you to just focus on the example, not on what I'm saying. Let's say my friend has a brand new working iPhone 14, but for whatever reason, he bought an iPhone 15. Or let's say he got a gift of an iPhone 15. Now today the value of that iPhone 15 is $1,000. So what I tell my friend is, so since you're anyway using your iPhone 14, you're not going to use this iPhone 15. So do one thing, just give me this iPhone 15 for a year. Next year when you need this phone, I will return it back to you brand new in the same condition, right? So the friend agrees and he gives me his iPhone 15. I take that iPhone 15 and I go and sell it into the market for how much? $1,000. Now I got $1,000 in my pocket. 1 year passes by, the value of that iPhone goes down to $800. So what I'm going to do now is, now my friend calls me up and he's like, hey bro, it's been a year, I need my phone back in the brand new condition which you took it. So I go back to the market, I tell the person I need a brand new iPhone 15. The person tells me the value of the iPhone is $800. I buy the phone for $800 and I return it back to my friend. So what exactly happened here? First, I went, borrowed the phone from my friend, sold it for $1,000. The price dropped by $200. Then what I did was I bought it back when my friend needed it. I returned it to him and I made a profit of $200 without even owning the iPhone. This concept right here is called short selling. It's quite fascinating. You might want to watch this video again and slowly understand what exactly I try to explain here. But this is what is called short selling. So similarly, in this case, if you want to make money from the prices going down on a certain asset, what you have to do is you need to have an account with your broker. And let's say you are thinking, as per your analysis, as per your speculation, you feel that the price of Bitcoin is going to go down. So what you will do, you will have an account with, let's say, Binance, for example. I hope Binance is still alive and well by the time this course comes out. But let's say you have an account with Binance, you open that account and you think Bitcoin is going to go down. So what you will do is you will sell, you will short Bitcoin. Now Binance has a lot of Bitcoin stored with them. So what technically you're doing is you are borrowing that Bitcoin from Binance and you are selling it out into the market for, let's say, $70,000. Now Bitcoin goes down by $2,000. Now obviously the Bitcoin that you sold into the market was borrowed from Binance, which means you need to return it back to Binance. If you don't, it will be a financial problem for you, right? And you will have to pay for the entire amount. So what you do is you buy back Bitcoin. Let's say your trade ends, the price drops by $2,000. You will buy back Bitcoin at the price of $68,000 and return it to Binance, because you borrowed one Bitcoin from Binance, you returned one Bitcoin to Binance. Just like in the previous example, you got one iPhone from your friend and you returned it back the same iPhone in the same condition. This is exactly what is happening over here. But the difference here is you got $70,000 in your pocket, you paid back $68,000, and the $2,000 difference was your profit. Now, this is what is short selling, and this is how it works in the financial markets. Now, let's say in case instead of the price going down, the price decides to go up. What happens then? Then obviously you incur a loss in this example. So this is the same thing. Let's say you took the iPhone from your friend. Going back to the first example, you took back the iPhone from the friend, you sold it for $1,000. Next year the price goes up for whatever reason, the price goes to $1,200. Now the friend wants his iPhone back. Now you have no option but to buy back the iPhone for $200 premium and give it back to your friend, because you have to give it back to your friend, right? Otherwise you might get in trouble. So you have to pay extra $200 from your pocket, buy that same iPhone and give it to your friend in the same condition. So in this case, the price went up and you are going to lose $200, and this will be your loss. So ladies and gentlemen, this is exactly what is called short selling. I tried to explain it in the most simplest manner possible. I hope you understood, but I just wanted you to remember that in trading, you can make money while the prices go down.